The magical world of ETFs explained. Do you ever wonder how investing wizards diversify their portfolios, hedge risks, and even profit during market downturns? I'm Seth Moran, a former managing director in equity sales trading with 20 years experience trading hundreds of billions of dollars in stocks, working alongside some of the most legendary investors of our time. And today, we're taking the Hogwarts Express into the magical world of ETFs, or exchange-traded funds. And I will explain for all the muggles out there,
Muggle.
and how they work, the advantages they offer, and the risks you need to be aware of before you invest. Whether you're new to investing or refining your strategy, ETFs can simplify your approach and free you from the stress of picking individual stocks and put you on the path to building a diversified portfolio. So let's head to platform 9 3/4 and see what ETFs are all about.
It's close!
I read about it in ETFs, a history. Let's rewind to the 1990s. That's when the first ever ETF debuted in Toronto, tracking the Toronto Stock Exchange 35 index. Just a few years later, the US joined the party with the Spider S&P 500 ETF. Today, SPY remains one of the largest and most traded ETFs globally. Fast forward to the 2000s, and ETFs gained massive traction worldwide. By the 2010s, innovation took off with thematic ETFs, ESG-focused options, and actively managed funds. And now in 2025, the global ETF market boasts over 15 trillion in assets under management across 9,000 unique funds. Talk about growth.
Just gonna go and get a drink. Does anybody want anything?
I'll have a cup of tea.
Yeah, get me a bourbon, would you, babe?
So what are ETFs? Simply put, ETFs are like baskets of investments holding stocks, bonds, commodities, or other securities. They're traded on stock exchanges just like individual stocks, but in addition, provide the diversification of mutual funds. And here's how they work. ETFs are like the magical wands of investing. Simple, powerful, and designed to make your life a lot easier. They're open-ended funds, meaning you can buy or sell them at any time and don't have to go through a massive process. Institutions, known as authorized participants, they're like the Gringotts goblins, create or redeem ETFs to keep the price aligned with the fund's underlying value. That means you're getting transparency, liquidity, and low cost all in one package. Just like Birdie Bot's ever flavor beans, ETFs come in many flavors to suit the different investment goals that you may have. There are equity ETFs, which track indices like the S&P 500 or focus on sectors like tech or healthcare. There's bond ETFs that offer exposure to government, corporate, or municipal bonds. There's commodity ETFs, think gold, oil, coffee beans, or orange juice here. Thematic ETFs, they capture trends like renewable energy or AI innovation. ESG ETFs for all those prioritizing sustainable investments. There's actively managed ETFs where portfolio managers actually handpick the assets themselves. There's even inverse and leverage ETFs for experienced investors looking to hedge or amplify returns. Now, I really want to emphasize experienced, seasoned investors here because you really need to know what you're getting yourself into, particularly with inverse and leverage ETFs, as their cost and tracking error are usually higher and their downside can be a lot steeper than their upside. So why are ETFs so popular?
I've read about those.
Well, for starters, diversification. A single ETF can give you exposure to hundreds of stocks or bonds, spreading risk like a Protego spell against financial volatility. They're also liquid, with shares traded throughout the day at market prices. ETFs generally have lower fees than mutual funds, saving you money in the long run. Plus, with daily transparency, you know exactly what you're investing in. Add to that the tax efficiency. Thanks to their unique structure, ETFs minimize capital gains distributions as opposed to index funds or mutual funds. Add everything together and you've got a winning combination, just like the Gryffindor Quidditch team. But as with any investment, ETFs come with risks that you need to consider.
Emendo!
There's market risk, and if the market or the index the ETF tracks falls, so does the value of your investment. Unless it's an inverse ETF, in which case you would stand to actually profit. Liquidity risk? While ETFs are traded throughout the day, some specialized ETFs, like those focused on niche sectors or small markets, might not be as easy to buy or sell quickly. There's tracking error. ETFs aim to match the performance of an index, but they're not perfect. Fees, trading costs, and other factors can lead to a small difference between the ETF's return and the index it tracks. Remember this, even if two ETFs are tracking the same assets, it doesn't necessarily mean that they'll have the same return. All ETFs are not created equal. And they can be complex products. Leveraged or inverse ETFs designed for sophisticated investors can amplify losses if the market moves against you. And here's one you might not expect. expense ratios. Let's unlock that now. Aloha. An expense ratio represents the annual cost of owning an ETF expressed as a percentage of your investment. For example, an expense ratio of 0.2% or 20 bips means you'll pay $20 per year for every $10,000 invested. And that isn't a check you have to write. It actually just comes out of the price of the ETF, or its NAV, which is its net asset value. These fees cover management costs, administrative expenses, and sometimes marketing. Now, while ETFs generally have lower expense ratios than mutual funds, often as low as 0.03%, it's important to factor these costs into your overall return. High expense ratios, especially in actively managed, leveraged, or niche ETFs, can eat into your profits over time. So what's a high ETF expense ratio? Well, generally anything above 1%. Basically, it's like buying a ticket for the night bus. Convenient in a pinch, but far too costly for regular use. So don't park your money there. Get in, get out, and hopefully make a profit. So the gist is, always check the cost before you invest in an ETF. ETFs are a global phenomenon, like the Tri-Wizard tournament. By 2000, their assets under management reached $79 billion. That figure crossed $1 trillion by 2010 and skyrocketed to over $10 trillion by 2022. The US leads the pack with 70% of the global ETF market, but regions like Asia Pacific and emerging markets are quickly catching up. Looking ahead, we're seeing exciting new trends: customizable ETFs, greater adoption in emerging markets, and even blockchain-based ETFs. It's a bit like watching the wizarding world embrace new magical innovations. Think of the ETF market as a financial version of Hermione Granger's enchanted handbag, constantly expanding, innovative, and full of surprises.
Always the tone of surprise.
With innovation at its core, the ETF market's future looks great and will undoubtedly continue to grow. Now, ETFs have come a long way from, again, a niche product in the 90s to a $15 trillion industry today. They offer accessibility, efficiency, and flexibility, but they're not without risks. Understanding the expense ratios, market volatility, and liquidity issues can help you make smarter decisions. Now, if you're new to ETFs or looking to optimize your portfolio, it's worth taking a closer look. The right ETF could be your gateway to smarter, more diversified investing. Think of it like choosing the right wand at Ollivander's.
The wand chooses the wizard, Mr. Potter.
Except in this case, with proper research and due diligence, you'll always have the power to choose the right ETF. Got questions or want to talk about your favorite ETFs? Let me know in the comments below. And don't forget to subscribe and hit that bell for more insights on financial literacy and building your wealth more wisely. Remember, kindness is the rent we pay on earth, so do something nice for someone. Which is kind of Luna love good ass now that I think about it. Anyway, have a great day. Huh? Have a great day? What the f am I talking about?